This is Paul Pablo Lemberg with the 15 vital metrics to improve any business. From the simple to the complex, these are the metrics which are vital for you to know about for your business and know them with a high degree of accuracy. These metrics are not listed here in order of importance. They are listed in an order that makes them easiest to explain. Many of these are named so as to be self-explanatory, but we'll go through them anyway. The first two, cost of goods sold and cost of services sold, are very closely related. Number one, cost of goods sold, or COGS, is what it costs you to make the products you sell. COGS will be different for each product, but it can also be considered as the total for all products sold. Lower COGS and you increase your operating profits. Number two, cost of services sold, or COSS, is what it costs you to deliver the services you sell, like coaching or medical services. As before, COSS may be different for each service you sell, but dealt with in the aggregate for all service sales. And as before, lower COSS and you increase your operating profits. Leads per customer is how many leads you need on average to get a new customer. Leads per customer is likely to be different for each marketing channel, and each is worth tracking. The inverse of this metric is called closing ratio, the number of new customers divided by the number of leads it took to get those customers. Number four, average cost per lead needs no explanation. Number five, cost of customer acquisition, or CCA, is what you spend to get a new customer. Multiply leads per customer by the average cost per lead to get CCA. Number six, gross profit is your revenue minus COGS minus COSS. Number seven, contribution margin is gross profit minus CCA. This is what you really have to run your business on. This can also be referred to as operating profit. Many businesses go bankrupt because they think gross profit is the money they have to run their company on. But this is not true because it doesn't consider your cost of getting each customer, which can be significant. Contribution margin is the actual amount of money you have to run your company. Number eight, long-term customer value. How much profit, specifically gross profit, you can expect to receive from your average customer over the time you expect them to be a customer. This metric tells you many things, most importantly, how much you can spend to acquire a customer and still be profitable. Number nine, overhead, or fixed costs. This is the amount of money you spend irrespective of how many customers you have. This includes things like rent, insurances, leases, professional services, and fixed payroll, and it doesn't change much month to month. Number 10, net profit is your company's total revenue minus all costs. Another way to look at this is total contribution margin from all sales minus overhead. This metric is also simply called profit or total profit. Number 11, total revenue and total profit. These are obvious, but you'd be surprised at how many business owners operate with a rough estimate of these rather than a firm number which they can count on. Number 12, year-over-year revenue growth rate and year-over-year profit growth rate. These are the rates at which your business is growing from one year to the next. Number 13, MBR, or monthly burn rate. This is the amount of recurring expense you have every single month. This is so important because when you divide your cash reserves by MBR, it tells you how many months your company can survive without making any new sales. Lower MBR to reduce your company's fragility. Number 14, MRR, or monthly recurring revenue. The amount of money you get from recurring payments like memberships or subscription fees. MRR is the amount of money you can count on each month without making a new sale. If MRR is greater than MBR, you're in pretty good shape. Number 15, revenue per employee. Just like it sounds, how much total revenue divided by the number of employees. Since your employee costs are typically the largest of all of your costs, increasing the total revenue by the number of employees is going to make a big difference. That's the 15. A very simple way to improve your business, potentially a lot, is to keep track of each vital metric and be creative developing ways to improve the metric. Do this for each metric and you'll be absolutely crushing it. While there are tons of other metrics you can measure and track, depending upon your specific business and specific industry, these 15 are the most essential to having a healthy, growing, and profitable business. This is Paul Lemberg. Track your 15 metrics, improve each one over time, and you will make a fortune.